Hello traders, Lance Ippolito here. Let's actually take an important few minutes to talk about the VIX and volatility and ways to play it if you're looking at protection or think the market is a little toppy here. So we can see the VIX, you'll see short-term pops in the VIX, but nothing really lasts. So we have the VIX here right at 10 basically with a little pop from that 884. But if you look at the VIX on a intraday point of view, so this is Sunday when I'm shooting the video, so Friday the VIX was down nearly 4%, 3.93%. If you just zoom in, you see the VIX just not doing much. So therefore, if you would have gone out and let's say you go out to, let's actually go out to October, 72 days, and you look at the options at the VIX, you can get the at the money 10 strike call for let's say 370. But so you add 370 to 10, so we're looking at 1370. But if I were to go to let's say VIX 20, it's about 85 cents. So in this instance, all I need is the VIX to become in the money at 1370. In this instance, at 20, I need 2085. So why would I go and buy these out of the money calls in the VIX? Let's say the VIX gets to 15 by October expiration. Well, these 10 strike calls make money. These 20 strike calls that I paid 85 cents for don't make any money. So what's the best way to play the VIX or to hedge? Should we look at call spreads? Is there obviously the options are juicy that are out the money? Just running a quick example, let's say I do the 10-20 call spread, I can actually pay $2.80 or $280 per contract for something like this where I risk $280 to potentially make $720. So not too bad of a risk versus reward. So I like call spreads if playing the VIX. But let's look at more popular strategies, I should say, volatility products that people like VXX. So VXX tracks the VIX futures, is the short-term VIX futures, so mostly making up front month VIX futures here. You can see VXX just, you really don't even have the short-term pops like you do in the VIX. VXX pretty much straight lower. And even though retail investors love VXX and UVXY, which has had a million splits before, you just see UVXY just basically not do anything. So if you were to go out to UVXY and let's say buy in September out of the money calls, look how expensive they are. I mean, look at this. So nearly, I need UVXY, let's say it's at 30 to double to 60. 60 strike calls are still $1.25. And the at the money calls are obviously more expensive, but you don't need it to double, so to speak. So UVXY is implying about a 30% move between now and September. Pretty crazy to think of it. So if you're buying out of the money calls, let's just look at the SEP. Let's just look at the SEP 35s of a chart of them, and you can see how they just erode away. We just see they're just eroding away in value every day that goes on, from $5, a little pop here back to 5 again, but just eroding now to $3, $3.15. So the one thing I like to do, if let's say I'm long a bunch of stocks or my portfolio is very long, is to play the VX, the VIX futures. Now, the VIX futures, you'll see here if you type in VX, they do expire in August, so you can go and pick different contracts that you want to look at. Just active are the August. So if you are, you eventually have to roll. But if we look at, where's the, there we go. So if we look at the VIX futures, you can see even though the VIX was down 3% on Friday, VIX futures were only down a tick, or nearly 0.5%. That is absolutely nothing. So the one thing I like to do, if I'm really worried about long portfolio, is just buy a contract of the VIX futures. Now you have to realize every point is $1,000, so keep that in mind. So if we go from 11 to 12 or 11 to 10, it's $1,000 per one contract. But I feel like this way you don't have to worry about the options eroding away. If you want to get long, you just buy a contract in the VIX futures and play it that way. I mean, you do still see, you'll have, these are all the time, uh, the monthly expiration to where you have this little pop, but really it's just you have to roll the contract. So you'll see usually, VX goes down too, but if you're super worried about portfolio, I don't feel like it's a horrible thing to do because it can move. I mean, you've seen times where there's volatility in the market, VIX futures will catch a bid. So I like playing the VIX futures more than the ETFs, or if I'm playing the VIX itself, looking at VIX, VIX, spot VIX call spreads as the way to manage portfolio insurance, or you just are prepared for a complete market crash. Another way to look at it is you can always look at buying SPY put options. As you see, volatility down here is historically very, very low in the SPY or really any other ETF. Whatever your book is looking at. If you're in small caps, the Russell, tech, the NASDAQ, vol is cheap. I just want to point that out there for this video to always keep that in back of your mind, even though the market is still chugging along with the Dow making new highs.